Welcome back to Alpha Recap, your daily market catch-up from stockalpha.ai. We wrap the market day and we've got a lot to unpack. As always, if you have questions, you can reach us at stockalpha.ai. Happy to be here. Markets closed lower today, and the tone was pretty clearly risk-off. So, what really stands out here is how much long-term bond yields drove the action.
Right. To put the headline on the table first. The S&P 500 exchange-traded fund finished down about 0.2%. The NASDAQ 100 exchange-traded fund slid just over 0.5%, and the Russell 2000 exchange-traded fund, small caps, dropped about 1%, a touch over 1%.
And the number that really caught our eye, the 30-year Treasury popped to just above 5.1%. That tightened financial conditions and weighed on longer duration names.
Yeah, that tracks. Higher long-term yields mean the cost of capital went up for growth companies. Basically, future earnings are worth a bit less when discount rates rise, and that hits long-duration and mega-cap growth more than others.
Exactly. Analysts note that with yields where they were, markets started to price a slower path toward rate cuts than some had hoped earlier this year. That changes the script for a lot of sectors.
Hold on, say that again. Slower path to rate cuts means what for everyday themes like housing and refinancing?
Mortgage rates track long-term treasuries, so when the 30-year Treasury moved up to just above 5.1%, mortgage rates followed. That reduced affordability and cooled refinance activity, which feeds into real estate, home improvement retailers, and construction names.
I mean, when you step back and look at this, that explains why Home Depot is on people's radars today after its comparable sales update. Higher mortgage costs are a direct channel to retail demand for housing-related goods.
Right. And the other thing is, investors rotated. We saw money flow into defensives like utilities and into select pockets of strength, including renewables and some materials names.
Utilities drew interest as a defensive bet, but also because of renewables momentum. Clean energy project pipelines were specifically mentioned as a support factor, even on a cautious tape.
Materials and mining held up too, helped by lithium and copper demand tied to batteries and electrification. That was one of the bright spots today.
Energy was a bit of a mixed bag. Europe-facing energy names faced regional headwinds, while renewables-focused energy companies attracted buying interest. So the sector split mattered more than broad energy weakness.
Communications and media also got attention. Investors favored more cash-generative names there as they dialed down on cyclicality.
Financials were all over the map. Some banks met expectations, others felt margin pressure, because rising long-term yields help nets on some fronts, but also complicate funding and loan dynamics.
Switching gears to individual names. NVIDIA was in the spotlight after a price target lift from one bank, which gave semiconductors a bit of intraday support, even though tech overall didn't escape the pullback.
And Hewlett-Packard Enterprise slid as the market digested company-specific commentary and earnings. Hardware and enterprise tech remain sensitive to capital expenditure cycles. When companies cut back, that shows up fast in results.
Home Depot, as we mentioned, drew chart watching after the comparable sales print. Analysts debated what it meant for home improvement demand in a higher mortgage rate world.
AT&T surprised some people too, with post-quarter commentary sparking questions around telecom fundamentals and dividend sustainability. Those are the kinds of themes investors look at when they shift toward defensive names.
There were also smaller stories moving names. Evertech's post-quarter positioning, constructive coverage on Granite Construction, and some geopolitical color from Deutsche Bank suggesting certain energy risk premiums may have eased. These micro-headlines added to the day's mixed narrative.
Small caps really underperformed. The Russell 2000 exchange-traded fund fell by about 1%, and that signaled weaker market breadth. Fewer names participated in any rebound, and that's often an early warning sign of risk-off internals.
Breadth deterioration is important. When the big indexes drift down but small caps fall harder, it typically reflects investors rotating toward liquidity and balance sheet strength. or just shying away from economically sensitive bets.
Crypto sent mixed signals too. Some profit-taking after recent rallies. Some continued institutional interest in certain tokens. Mixed crypto performance sometimes drags on cyclical risk appetite, but it wasn't the main story today.
Technically, people were watching key support levels in the S&P 500 and NASDAQ 100. A break below recent swing lows could invite deeper selling. Conversely, if yields stabilized and pulled back, growth leadership could get a second wind.
Analysts note that Fed comments and upcoming economic releases, especially inflation and employment, will matter a lot. If data stays firm and yields stay elevated, the Fed could end up moving later on cuts than markets had hoped.
So what should listeners be watching tomorrow? Number 1, the 10 and 30-year Treasury moves. Number 2, any Fed speakers or fresh inflation and labor market data. Number 3, ongoing earnings and CapEx commentary from big tech, industrials, and consumer names. And don't forget housing prints and mortgage indicators after today's yield move.
Honestly, I was a bit surprised by how quickly the 30-year move rippled through so many sectors. But when you think about it, that magnitude in yields directly translates into higher borrowing costs for businesses and consumers.
Yeah, absolutely. Historically, periods like this, when long-dated yields reprice higher, have tended to hit small caps and long-duration growth harder, while value and defensive sectors outperformed. Today, fit that pattern.
Short reactions, big move. Not what anyone expected by the close, and mixed headlines everywhere.
Also, only in market land do we get political quips and oil shock history analyses showing up in the same morning. A fun reminder that markets are driven by both data and narratives.
Bottom line summary. Markets closed lower. S&P 500 ETF down about 0.2%, NASDAQ 100 ETF down just over 0.5%, and the Russell 2000 ETF down a bit more than 1%. The dominant theme was rate sensitivity as long-term treasuries moved higher, with pockets of strength in renewables, materials, and select consumer names.
Key takeaways. First, watch Treasury yields. They were the day's main driver. Second, Fed communications and incoming macro prints will be parsed for any sign of a slower path to easing. Third, earnings and housing data remain important because they can quickly tilt sector leadership.
If you want to dig deeper into any names or themes we mentioned, head to stockalpha.ai. And remember, if you have questions about anything we covered today, you can ask us directly through the Q&A feature at stockalpha.ai.
We're not giving advice, just laying out the data and what analysts are saying. If you have follow-ups, go to stockalpha.ai and ask. We'll answer live when we can. For more market analysis and insights, visit stockalpha.ai. Thanks for listening.
Thanks for joining us on Alpha Recap. We'll see you after the next close. Take care.